Ladies and gentlemen, good day and welcome to Mahanagar Gas Q4 FY22 earnings conference call hosted by Yes Securities Limited. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nitin Tiwari from Yes Securities. Thank you, and over to you, sir.
Thank you, Aman. Good evening, everyone. I welcome everyone to Mahanagar Gas Limited's fourth quarter and FY22 earnings call. We have the pleasure of having with us today the senior management team from Mahanagar Gas Limited, represented by Mr. Sanjeev Dutta, Managing Director, Mr. Sanjay Shende, Deputy Managing Director, Mr. Rajesh Patel, Chief Financial Officer, and Mr. Rajesh Wagle, Senior Vice President Marketing. I will now hand over the floor to the management for their opening remarks, and that shall be followed by an interactive Q&A session. Over to you, sir.
Yeah, hi, Neha here from EY. Thank you, Nitin. Before we begin, I would like to mention that some of the statements made in today's discussion may be forward-looking in nature, and we believe that the expectations contained in the statement are reasonable. However, the nature involves a number of risks and uncertainties that may lead to different results. The risks and the uncertainties relating to this statement include, but are not limited to, risks and uncertainties regarding fluctuation in sales volume, fluctuation in foreign exchange, other costs, and our ability to manage growth. I urge you to consider that quarterly numbers are not a reflection of a long-term trend or an indication of full-year results. They should not be attempted to be extrapolated or interpolated into a full year number. Thank you, and over to you, sir.
Thank you very much. Good afternoon and welcome to the earnings conference call of Mahanagar Gas Limited for the fourth quarter of the financial year 2021-2022. I would like to thank all of you who have connected for our earnings call today. India is witnessing recovery in economic activity after COVID, accelerated pace of vaccination, uptick in consumer and business confidence with better outlook on the general economic situation have resulted in greater degree of optimism. However, adverse residual effects of the pandemic across the globe, coupled with major geopolitical upheavals, have resulted in a surge in commodity prices matched by high inflation. Crude oil price has soared to above $100 per barrel, and likewise, imported RLNG prices have touched new highs. For MGL, Q4 of FY 2021-2022 was impacted by the third wave of COVID, resulting in lower sales volume, but the recovery has been fast and the average gas volume sold in March 2022 increased by 14% as compared to that of January 2022. Despite the second and third waves of COVID, we could fast-track our infrastructure creation efforts across MGL's existing license areas during the last financial year. During the last quarter, 79,130 domestic households were connected, and thus we have established connectivity with about 1.86 million households. During FY 21-22, we provided connectivity to 2.62 lakh households and bettered our previous best of providing 1.98 lakh connectivity. We laid 125 kilometers of steel and PE pipelines in the quarter, thereby taking the aggregated pipeline length to about 6,221 kilometers. We added 14 new CNG stations in the last quarter. With these, we currently have 290 stations. We also added 107 industrial and commercial consumers, and thus, as on quarter end, we have 4,339 industrial and commercial customers. In respect of our Raigad geographical area, we are connected to 53,030 domestic households and 23 CNG stations are currently operational. During the quarter, we laid 26.23 kilometers of pipeline in Raigad GA, thereby taking the total length of pipeline to 346 kilometers. Such expansion of our pipeline network has also resulted in commissioning of the first online CNG station in Raigad GA at Somatane. In January 2022, the company achieved inch kilometer target as per PNGRB's minimum work program for Raigad GA. You may recall that we had already achieved the cumulative number of domestic PNG connections target by March 2020. So with this, the company fully met its minimum work program targets for Raigad. Possibly MGL is the only CGD company which has completed its minimum work program against a bid-out license area. This shows the company's sincerity in adhering to its commitments. Coming to MGL's operations, average sales volume for the year ended 31st of March 2022 is 2.999 MMSCMD, whereas it was 2.211 MMSCMD in the corresponding period last year. Thus, there is an increase of 35.63% in the overall sales volume compared to the previous year. Average sales volume for the year ended 31st March 2022 of 2.999 MMSCMD consists of CNG volume of 2.114 MMSCMD, domestic PNG volume of 0.466 MMSCMD, and industrial and commercial segment volume of 0.419 MMSCMD. Compared to the previous year, sales volume in case of CNG has increased from 1.415 MMSCMD to 2.114 MMSCMD, which is an increase of 49.4%. In case of industrial and commercial sales, volume has increased from 0.332 MMSCMD to 0.419 MMSCMD, which is an increase of 26.2%. Domestic PNG sales volume has increased marginally from 0.464 MMSCMD to 0.466 MMSCMD, which is an increase of 0.43%. EBITDA for the financial year 2021-2022 is rupees 924 crore compared to previous financial year EBITDA of rupees 934 crore. EBITDA margin is at 25.96% for financial year 2021-2022 compared to previous financial year EBITDA margin of 43.39%. Net profit after tax for financial year 2021-2022 is rupees 597 crore compared to net profit after tax for previous financial year of rupees 620 crore. Aggregated sales volume to the priority sector was more than available APM gas allocation, which resulted in shortage in the range of 15 to 17% during the quarter. This gap was met through purchase of market price gas. Spot gas prices remained high due to various global factors. Thus, priority sales volumes beyond APM gas allocation and substantial increase in spot gas prices had put pressure on the margins of priority sector during the quarter. Nevertheless, as a customer-focused company, we met the total demand of priority sector without imposing any dry out. However, the company undertook upward revision of CNG and domestic PNG prices in January 2022 from rupees 63.50 per kg to rupees 66 per kg and from rupees 38 per SCM to rupees 39.50 per SCM respectively. Government of Maharashtra reduced VAT on natural gas from 13.5% to 3% with effect from 1st of April 2022, and consequently prices of CNG and domestic PNG were reduced to rupees 60 per kg and to rupees 36 per kg per SCM respectively. Further, notified price of APM gas was revised from $2.97 per MMBTU to $6.14 per MMBTU with effect from 1st of April 2022. And the company passed through the above increase in gas costs through its retail CNG and domestic PNG prices in a phased manner during April 2022 and revised CNG and domestic PNG prices from rupees 60 per kg to rupees 76 per kg, and from rupees 36 per SCM to rupees 45.50 per SCM respectively by the end of April 2022. In case of supplies to the INC industrial and commercial customers, high RLNG costs had put pressure on margins as the industrial and commercial sales prices are linked to alternate fuels, which did not see similar increases. The company has partially recovered the margins by charging premium over alternate fuel link prices. To reduce dependence on spot gas and optimize the overall gas purchase portfolio, the company had entered into a contract for purchase of term gas for a period of 18 months, and during Q4, another term contract was signed for a period of 5 years. Coming to quarter-on-quarter comparison, average sales volume for Q4 of FY 2021-2022 is 3.170 MMSCMD and is lower than previous quarter average of 3.303 MMSCMD. This reduction is mainly due to third wave of COVID, which struck in January 2022. Such average sales volume of 3.170 MMSCMD consists of CNG volume of 2.277 MMSCMD, domestic PNG volume of 0.474 MMSCMD, and industrial and commercial volume of 0.418 MMSCMD. Q4 EBITDA has substantially improved to rupees 215 crore as compared to rupees 103 crore in the previous quarter. EBITDA margin has increased to 19.83% for Q4 compared to previous quarter EBITDA margin of 10.03%. Net profit after tax for the quarter has increased by 132% to rupees 132 crore from previous quarter net profit after tax of rupees 57 crore. As you would be aware that on 6th of May 2022, Ministry of Petroleum and Natural Gas has come out with the guidelines for domestic gas supply to CNG and domestic PNG segments of CGD networks. The guidelines aim to meet 100% of CNG and domestic PNG requirement of CGD entities through a mix of domestically produced APM, non-APM, and HPHT gas duly supplemented through term or spot RLNG as required. CGD entities are now expected to get such pooled natural gas 2.5% over and above their 100% requirement of CNG and domestic PNG segments of each geographical area calculated on the basis of consumption in the previous quarter. Such revision in gas allocation policy is expected to have a positive impact on CGD sector with regard to availability and overall pricing, thereby facilitating the CGD companies to deliver better results. MGL's Board of Directors has approved final dividend of rupees 15.50 per equity share for financial year 2021-2022. Thus, along with the already paid interim dividend of rupees 9.50 per equity share, total dividend for financial year 2021-2022 stands at rupees 25 per equity share, which is an increase of 20% from the 230% dividend paid for financial year 2020-2021. With this, I conclude and would now like to open the floor for questions. Thank you very much.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Prabal Sen from ICICI Securities. Please go ahead.
Thank you for the opportunity. Good evening, sir. Sir, the first question was with respect to the gas supply new guidelines that you mentioned, which should be net positive. Just to understand, what has been put out is basically that, two things. One is shortening of the review period to a quarter from 6 months. And second, it is still basically the intent to supply 100% gas on a best effort basis. But if we look at the domestic gas supply that has been made available over the last several months, very clearly there is no additional domestic gas that will be made available. And the balance has to be met from premium gas as well as spot LNG. So I'm just kind of trying to understand how does it change things for us from what is there currently, where in any case 15 to 18% gas is being met by market price sources. So what changes with respect to these guidelines, sir? If you can just give us some thoughts on this.
It's just a couple of days, so we still haven't got to do a full analysis yet. But what we believe would, the way it would pan out, will be that immediately whatever spot gas or term gas which we are procuring on our own and pushing into the priority segment will get replaced by whatever market price gas GAIL is able to procure immediately. Maybe in the immediate term it could be spot, so maybe our spot may get replaced with GAIL spot, but at a common price for all CGD companies. And since this is not a one-time thing, this is a sustained kind of a policy thing. Over time, GAIL will try to procure some HT gas at whatever price ceiling which is coming in as per the formula, and pull that into the requirement for CGD. If that HT gas contracting takes some time, till then our understanding is GAIL will also explore getting into some term RLNG contracts which could be cheaper than current spot prices, and pull that into the CGD gas requirement pool. So it looks like a positive step. How much actual the quantum of reduction in gas cost, that we will have to see as the time goes by.
Right. And just to, as a follow-on to that, in the near term, sir mentioned that you have signed a term LNG contract which is extended even in this year for another year or so. So can we get a sense, barring whatever domestic allocation is there, how many term LNG contracts do we have, and what volume have we tied up for the next year or 18 months right now?
We have got 3 term gas contracts. Not all are RLNG. One is of domestic gas, and that is with Reliance.
Okay.
We have one with GSPC, and we recently entered into one with GAIL for the Henry Hub.
Okay. So is it possible to share the volumes that have been tied up, sir?
The volumes are, these contracts have confidentiality clauses, so volumes and how much turn down you can go, etc., that we will not be able to disclose.
Okay. So the other small question I had was with respect to the margin profile. I think it was mentioned that alternate fuel pricing, at least in the initial part of Q4, was adverse compared to your LNG-based pricing for industrial commercial. Now, what we have seen is, if we look at one major alternate fuel for us, tends to be commercial LPG prices, and those have obviously gone up very sharply in line with the fact that Asian LPG prices have been going up very, very fast. And we are also seeing LNG prices have come off a little bit, at least in April. Is it fair to assume that, in this kind of a scenario, the margin profile can improve fairly sharply, at least over Q1? Is that something that you're seeing on the ground, on your pricing front?
Could you repeat your question, please?
I was saying that for industrial and commercial, sir, LPG tends to be a fairly material alternate fuel for us from a pricing standpoint, and our understanding is that LPG prices have been going up fairly sharply, and at the same time, so LNG prices and spot LNG prices have come off a little bit in the last couple of weeks in April. So are we seeing any improvement in terms of our pricing power and therefore margins in industrial commercial segment in 1Q of FY23?
Yeah, there is, all other things being constant, yes, these two factors would lead to an increase in gross margin. However, you also need to keep in mind that, when the LNG prices were very high, we had gone to a substantial premium over alternate fuels. So once the prices of LNG have cooled down a bit, we have also given some relief to our customers from that very high premium level. But on an overall basis, yes, hopefully it should be positive.
Thank you. Mr. Sen, request to join the queue for any follow-up. Also, before we move to our next question, I would like to remind the participants to limit their question to 2 per participant. If time permits, you may join the queue for any follow-up. We have the next question from the line of Aishwarya Agarwal from Nippon India AMF. Please go ahead.
Yeah, thank you. Sir, have we taken enough price hikes for the CNG so that our margin reaches to 10 rupees per SCM?
If you noted MD's speech, price of CNG was 60 rupees per kg as of 1st April, and currently it is at 76 rupees per kg, and in similar proportion increase has happened in domestic also. This price increase fully covers the APM gas cost increase from $2.97 per MMBTU to $6.14 per MMBTU.
So my question remains, sir, are we generally we used to do some 10 rupees of per SCM margin. So have we reached there, or we need to take some more price hikes to reach there? Because lots of volatility in the prices in between, which has led to volatility in the margins also, which we have been reporting in the last 2 quarters.
If you look at the price rise which was taken up to Q4, it covered the amount of RLNG being used in the priority sector. So current price rise which we have taken is mainly towards APM price rise from $2.97 to $6.14. And with now, spot prices coming down, and also the way just now we spoke, cool gas, I think prices are likely to remain, and it covers more or less the cool cost as well at the current level.
Sure, I got it. Second question, sir. Yeah, go ahead.
If you look at margins, I think overall company per SCM margin is in the range of around 13 rupees 60 paise or something. And if you look at margins for priority sector also, we are almost making similar level of margin. If you look at 19-20 level of margin. Of course, I think 2021 was slightly abnormally high because of APM prices are very low. Okay, so during that year, more or less we are in line with the margins which we have been making in the past as far as priority sector is concerned.
Sure, sure, sir. This is helpful. Second question is, with this, how do we see the growth as of now? The growth in the CNG volumes, because what I can see that the fourth quarter has a weaker growth on a quarter-on-quarter basis, and that may be because of the COVID, I guess, and lesser number of days. But how do you see the growth now on a year-on-year basis at this point of time?
Well, if you take out the COVID period, typically last 4-5 years, we have seen a CAGR of about 5-6% or so. But now we are seeing a better growth compared to that. A lot of growth is coming now from the CNG segment. There's a combination of factors, which has resulted in that. One is that, petrol and diesel prices are at historically high levels. Second is almost all OEs now are coming up with factory-fitted CNG variants, at not just entry level, even mid-level cars, etc. Apart from that, of late, a lot of commercial goods vehicles have started coming with CNG variants as OE from factory. And because of the price of diesel, there is a good number of new CNG fueled commercial vehicles which are coming onto the market.
If I may add to that, the commercial vehicles addition is very good every quarter on quarter, and almost 2,800 numbers of vehicles have been added in this quarter as well. And this number is likely to continue for some time because of OE vehicles on CNG.
Sure, sir. That is very good. And the last question, sir, if I may, that from 1st of October, when this APM gas prices will further move up to, say, $9, and we have some gas available from the GAIL as per the new policies. So, I mean, at that point of time, I don't know what the diesel prices will be, but I mean, our growth and the margins are also dependent on the diesel price, correct?
You are right. I think it is anybody's guess what will be the price in October of alternate fuels like diesel and petrol. And also, currently the spot price at a particular level, that may also come down. Okay. So we'll have to wait and watch how it pans out with respect to APM price, spot price, what is this pooled price which comes up, and also, as you said, alternate fuel prices. And accordingly, we'll have to take an appropriate decision, keeping in mind how does it impact the CNG vehicle conversion, etc. So we will try and balance out the volume growth and pricing both. However, our endeavor will be always on to add on to new vehicles and add on to the gross margin on absolute terms going forward.
But there is no clarity of ONGC's gas prices having some cap which can help city gas companies.
No, not really. We haven't heard anything on those lines. And only thing is, we are hoping that by September or so, and GAIL should be in a position to source some turn gas or HPHT gas which will replace the spot gas, which currently may go into the pool. So that decrease in cost to some extent will offset the cost of APM price increase. For the final number, as Mr. Patel has said, we'll have to wait and see how it pans out. But currently, we do have sufficient headroom because petrol is 120 plus in our GAs. Diesel is also about 104, 105 rupees. We are at 76 rupees.
Sure. Thank you, sir. Best of luck.
We are almost at a discount of around 55-57% compared to petrol, and almost 28-30% compared to diesel as of today.
Sure. Sure, sir. Thank you. Best of luck.
Thank you. The next question is from the line of Vikas Jain from CLSA. Please go ahead.
Hi, thanks for taking my questions. On the LNG, on the contracts that you mentioned 3 of them. One is with GSPC, the other is with, I think, the US LNG contract, and thirdly is the new gas contract or the deep water gas. So all of those 3, what is the tenure of these contracts? These are like 5-year contracts. How long are these contracts?
2 of these for 5-year term. One is for 18 months. Reliance
6 years. One is 6 years.
One is 6 years.
One is 5 and one was 18 months.
Okay. And so in the current scenario, where after this policy has come into being, is it fair to say that these contracts will be more than your requirement of industrial and commercial gas in terms of volumes? Because
not really. The way all these contracts are structured, we have to manage within the contract. There will not be any impact as far as industrial and commercial volumes are concerned. It is within the minimum threshold.
Not running to any take or pay.
We have got enough downward flex freedom in these contracts to ensure we don't land up in a take or pay regime.
Okay. Basically, you've been doing industrial commercial of about 0.4 MMSCMD or a little more than that. Then these contracts add together to be lesser than that. You have enough flexibility around that. Yeah.
Yes,
So,
but also our industrial and commercial volumes are also growing at a good rate
yeah,
now.
of course, yes. And so for the remaining, now just coming back to this new policy that has been announced. Now, is my understanding correct that the domestic gas allocated to city gas has been fixed at the level which were prevailing as 6 months back? So, and as city gas demand rises, the gap between that level and whatever is the demand will all be filled up by either spot or term or the new deep water gas. So domestic gas will not keep falling down for now. Is that understanding correct?
No, we don't have that kind of clarity available to us right now. So
Okay.
I don't think the ministry's pricing or order also goes to that level of detail.
Okay, but it does mention that there will be some domestic gas and remaining has to be fulfilled by LNG or whatever way, or deep water gas, right?
What is shortfall?
Yeah, whatever is the shortfall. I mean, so that's what I meant, that shortfall is based on a fixed level of domestic gas that you think is not sure, that you're not sure, right?
That explicit clarity is not available in public domain.
Fair point. So this, is it fair to now understand that first will be on 16th, I think. 16th is when it starts, right? So from here on, at the start of every quarter, or will it be at the start of every month, a pooled cost price will be declared by GAIL or who's running the pool?
The GAIL is running the pool.
PPSC will probably vet the price
and GAIL will run the pool.
Thank you, Mr. Jain. Request to join the queue for any follow-up as there are several participants waiting for their turn. Thank you. The next question is on the line of Sabri Hazarika from Emkay Global. Please go ahead.
Yeah, good afternoon, sir. So I have two questions. The first one is related to this domestic gas guidelines only. Wanted to know if you are getting the allocation say from 16th of May for this quarter, then it would be the total priority sector volumes of last quarter which will be considered, right? Which is both APM plus the amount of LNG you are using, or would it be just APM?
So it will be considering the sales volume of priority sector of last quarter, and onto that 2.5% as per the circular or the ministry guidelines.
Not last quarter's APM allocation. It will be last quarter's total volume.
Not last quarter's APM allocation. It will be last quarter's priority sales volume plus 2.5% over that.
That is CNG and domestic PNG sales volume.
Okay, so for example, just a hypothetical situation in Q1, suppose if you are doing certain amount of priority sector volume, where sizable say 25% component is LNG. So next in the subsequent quarter, this LNG part of priority sector would also be part of the pool, and on top of that you will get 2.5%. Is that right?
Obviously, otherwise it does not make any sense, correct? If today...
Yeah. Okay. Then, it is basically at this juncture also, last quarters, spot LNG, whatever you have been using, that will be replaced with the pool gas. That's what you are saying, right? From this quarter itself. Okay, sir. Secondly, I've got a few small bookkeeping questions. The first one was, what was the overall shortfall of priority segment for the full year? You said 15 to 17% in Q4. What would this be for the full year?
Full year was in the range of, very difficult to answer, but around 8-9% on an average. Full year, April 21 to March 22, including the period of COVID, when full allocation was available. So roughly 8 to 9% it was.
Okay, and what would be your average industrial and commercial price for the full year?
Average commercial and industrial price for the full year. For industrial, roughly 47 rupees per SCM. Okay. I'm talking price realization, net of taxes. Yeah. And commercial roughly 56 rupees on an average for the full year.
Okay, and what would be the Q4 industrial volumes and commercial volume breakup?
Industrial volume was 0.252 MMSCMD and commercial is 0.166 MMSCMD. Q4 this year.
Much and all the best.
Thank you. The next question is from the line of S. Ramesh from Nirmal Bang. Please go ahead.
Hello, good evening, and thank you very much. The first question is, in this new arrangement
Your voice is breaking. Request you use the handset. There's an airy disturbance from your line.
Hello.
Not very clear, sir. Can I request you to please be a bit loud?
Yeah, can you hear me now?
Yes.
Yeah.
Yeah. So, with reference to the new gas allocation scheme to be managed by GA, now, in terms of your ability to respond to change in your overall blended cost of gas, how would it change in terms of the lead or lag? Because so far you were controlling your gas procurement and the blended cost and the price to all the CGD companies. So, how do you see this impacting the way you change prices every month or every quarter, particularly for the industrial and commercial segment where you review it every month, and for CNG and the domestic PNG prices, as and when you're changing the cost of gas, war and such, how do you see this play out?
Let me clarify. I think you are mixing up the two things. The APM gas allocation was always given by government. Only in whatever post-COVID, because of the shortfall, we started buying and using spot for this segment. Whereas industrial and commercial, we always had market determined gas, and it will always remain that way. Whatever new guidelines has come, it is only for the APM. So whatever happened post-COVID and individually the CGD started blending or putting their own spot gas. Now that part is being addressed through this pooled gas mechanism. So there is no change as far as our freedom to buy gas and other things is concerned. Priority gas was always available through government and it will be available going forward as well. However, it now will be in this new guideline and it will be a pooled mechanism through which the gas will come to CGDs.
Okay. Second thing is, in terms of the notes to the accounts regarding the trade commission payable to OMC, what is the impact which are provided for in this quarter, and what is likely to be the full impact once the trade commissions are finalized?
Yeah, as far as impact is concerned, we have taken appropriate provisions since the beginning. So there is no impact as such, additional in this quarter compared to earlier quarter or earlier 9 months. Okay.
So for the full year, what would be the impact in rupees per SCM or in rupees crores, or can you quantify that?
No problem. See, whatever is the ministry guideline, in line with that, we have made appropriate provision. And there is no additional impact as such for Q4.
No, but for the full year, if you have to understand how it's going to impact your future pricing and margin, it will be useful if you can share that information in terms of what is the value of that impact you have provided for. Because obviously in terms of the commercial impact, there is a reduction, right?
Just like gas price increasing and we do the pass-through in the pricing, similar is the manner for which, trade discount also we factor in while doing the pricing. So we have already done that factoring in and it will continue to, we continue to do so. Okay. So there is no impact on the margins per SCM on account of this factor at all.
If I might just squeeze in one last question, what is the kind of capex you have in mind for FY23 and 24?
Current year, I think we have spent in the range of 600 crore. It should be in maybe 600 crore, a little more than that. However, company is ready to go for more capex than that also, and we have approval in place from board. But it depends on how things pan out with respect to permissions which we need from local authorities, sometimes railway crossing, availability of land for putting up CNG stations, etc. So we are geared up to do required amount of capex, and it could be in the range of 600-700 crores for the next year as well.
Thank you. The next question is from the line of Maulik from Equirus. Please go ahead.
Yeah, thanks for the opportunity. So one question. CNG volume took on a relatively larger dip in this quarter on QOQ basis. Was there any impact of this MSRTC strike which was happening in Maharashtra since November 2021?
And MSRTC has only a couple of hundred buses. It's negligible. It's not even 0.2 or 0.3% of our volume. So.
Okay. And second question is that related to this policy, as you mentioned that you had this two-term contract signed in the last 4-5 months, one with GSPC and second was one with GAIL for Henry Hub. Now, and I understand that both of their the pricings are currently lower than the prevalent spot LNG prices. So does that you will have a increase in the cost post implementation of this policy for the priority sector volume?
The policy has just come out on Friday. So
yes.
Can you be a little more specific what you are referring to?
Basically, in your priority volume mix, right, you have an APM and you have this two-term contract which you have signed in the last couple of months, right?
Oh.
This term contract pricings are currently probably in the range of $12 to $16 per MMBtu, assuming this is a term contract. Whereas the spot LNG currently is in the range of $20 plus MMBtu. Now, if GAIL gives you this APM price, that GAIL creates a pool of APM and the spot LNG, which is currently the only spot LNG is available, and then it supplies to you. Will the pool price will be higher than the current price what you are getting it today?
No, for whatever is the gap in our priority volume requirement, mostly it was catered through spot. Okay. So that will get replaced by the spot which is going to get tied up by GAIL for all CGDs put together. That's not going to have any.
So in the immediate term, we are not expecting to see any material change in our cost of gas. However, going forward, maybe a month, 2-3 months, depending on how GAIL is able to source term gas, be it domestic or be it RLNG, we are hoping that our cost of gas will go down.
In fact, now
this term contract which you signed was entirely from
your. There was no clarity and everybody was using spot. At least now there is a clarity and it will be replaced in the medium to short term with term RLNG or HTPT gas, which will reduce the cost substantially.
It's a big uncertainty which has gone away in our gas sourcing.
Thank you, Mr. Maulik. Request you to join the queue for any follow-up. Also, reminder to our participants to limit their question to one per participant. If time permits, you may join the queue for any follow-up. The next question is on the line of Iqbal Khan from Edelweiss. Please go ahead.
Hi, sir. So, I have two questions. One is bookkeeping question. So you mentioned that the industrial and commercial customers are around 4,339. Could you please give us the breakup of the industrial and customers separately? And you also mentioned that there are 14.
Hello. You're not able to hear you clearly.
Mr. Khan, request you to use the handset. Please, your voice is muffled.
Can you hear me now? Is it better now?
Yeah, please go ahead. Let us see.
Little better.
Yeah. I wanted the breakup of the industrial and commercial customer, which you mentioned that it is 4,339. So I wanted a breakup of that. And also, if you can give us a breakup of.
Still breaking. Request you to come in network area, please.
I hope it's better now.
Yeah, this is much better.
Industrial customer. Number of industrial customers, number of commercial customers.
Yeah. And also, breakup of the BHT fleet. In the last quarter, you had mentioned that it was around 2,200 CNG buses, 800 diesel, and 200 EVs. So could you please give us the current breakup of the BHT fleet?
Can I address your first question because your voice is not
please.
First question answer is we have around 88 industrial customers and rest is commercial customers. Number 4,000 odd. 88 is industrial and rest is commercial, which is around 4,200 plus.
Got it.
Yeah. Okay. What is your next question?
Yeah, and the next question was the current best fleet. So in the last quarter, you had mentioned that there was around
2,400 CNG buses, 800 diesel buses, and 200 EV. In the last quarter, you had mentioned about this. So could you please give us the breakup as a
around 2,500 buses from this BFC, TMT, etc., and around 600 odd buses from private operators. So it makes around 3,100 buses roughly.
Thank you. The next question is from the line of Varatharajan Shivakrishnan from Antique Limited. Please go ahead. Sorry.
Thank you. Thanks for the opportunity, sir. I just wanted clarity on the 5% CNG volume drop. You addressed it partially, but you didn't give the full explanation what drove the decline.
Sorry, can you please repeat the question? We're not audible.
On a QOQ basis, your CNG volumes are down 5%. So what drove the decline? Was it that you were holding back because of supply? Sorry?
No, it is hardly 0.43% down compared to PNG.
Yeah, CNG.
You're saying CNG volumes?
Yeah, that's right.
Yeah, CNG volumes are down by 4% compared to the previous quarter, mainly due to January and February had impact of third wave of COVID. So I think there was a restriction on traffic and all that mobility, so that has impacted.
So my second question is that 2,800 CVs you mentioned for the quarter. Is it all OEM new vehicles or there is a significant portion which was retrofitted? Give us some
We are actually not able to hear you.
Sir, in terms of the... Yeah, just one second.
Varatharajan, please use the handset, sir.
Second. Is it better now?
Yes.
Yes.
Yeah, the 2,800 CV numbers you mentioned, were they all OEM vehicles or was there a significant portion which was retrofitted as well? Any kind of
majorly OEM. Very few retrofit. Retrofits and commercial good vehicles are almost negligible.
Almost negligible. And would you have a similar kind of a feel in terms of the private vehicles? What proportion could be OEM or what proportion could be retrofitted?
It's again predominantly probably around maybe 90% or so would be OE. Retrofit is now slowly going away because all the manufacturers are coming out of factory fitted variants, which customers typically are more comfortable with. You know, there is a warranty behind it, there is a manufacturer standing behind it, the quality is much better. So previously when OE fitted models were not there, then a lot of people used to retrofit.
Great, sir. Thanks, sir. I have a couple of questions. I'll come back and make you.
Thank you. The next question is from the line of Niharika Jain from Equitas Investment Consultancy. Please go ahead.
Hello. Good evening. Am I audible?
Yes.
Yeah. Okay. So in the current quarter, the total domestic sales is of 2.75 SCMD, which is CNG and PNG domestic. So, and we already in last quarter we had told that we have 0.15 SCMD of 18 months of LNG contract and some 0.1 SCMD. So how much of our quarter 4 quantity did we get from contract and how much did we procure from spot?
Should be roughly 0.45 to 0.5.
0.45 to 0.5 of spot are we talking about, sir?
In private sector.
Hello?
Term contract you are asking, right?
Yes, yes. So term contract, how much were we able to procure in quarter 4?
All the contracts put together roughly 0.45.
Okay. And spot would be around, you mentioned around 14% or so. So out of 2.75, so 14% would be the shortfall towards APM, is it?
So you are now right now asking only about, I gave you the figure for the company level. Are you asking right now about only priority sector?
Only priority sector, yes.
Okay. So if 2.75 was the average, roughly 2.5 was APM and rest is spot. Not term contract, spot. 0.25.
Okay, so contract went towards commercial and industrial, you mean?
Term contract.
I'm just trying to understand the 2.5.
Term contract is primarily for industrial and commercial. You're right.
Okay. Got it.
And if there is any volume flexibility in it, we can try to optimize our cost of gas. If that gas is cheaper and if additional upflex is there, we can push some into the priority segment in place of spot, and vice versa.
Thank you. Ms. Jain, requested to join the queue for any follow-up. Our next question is from the line of Harsh Bora from VT Capital. Please go ahead.
Hello. Am I audible?
Yes.
Yeah. Sir, my question was regarding the mobile refilling unit. So, is there only one MRU, or have we added more during the quarter?
We are on the verge of giving 3 more LOIs for, again, there is a change in terminology. This is not a MRU. This is now called a CDU, a composite dispensing unit. And in a few days' time, we are expecting to give 3 more LOIs.
Sir, and what will be the timeline after issuing the LOIs, the time it will take to commit onto the ground?
Well, it is difficult to pinpoint that, but we are hoping that maybe 6 or 8 months there should be some movement. Because currently, the safety regulations, etc., they are slightly, the one which we ran, we got under a pilot program kind of a thing. But now that we want to run this as a regular business, probably the safety and other regulators will be taking a closer look and examining, before giving their final approvals for commercial application.
Okay. Sir, and what are the GAs you are looking to implement this new composite dispensing units, like Mumbai, Thane, and Raigad?
It's primarily for city areas where land parcels of sufficient size are not available. Because if we get 400-500 square meters of land, we can easily set up if the pipeline is not there, we can set up a conventional DBS there, which is usually more cost effective than a CDU. It is only in case where, it's only 150-200 square meters of land and, that land is not available for 10-15 years, it's of a shorter duration, then we can deploy this CDU there. And if after 3 or 5 years, your rights over the land go away, you can always relocate that CDU to another parcel somewhere.
Thank you. The next question is from the line of Mukesh Manik from Valum Capital. Please go ahead.
Yes, good evening, sir. Am I audible?
Yes, you are audible.
Great. So just one question from my side. The commissions that we are paying to OMC, are they on margin basis or are they on a fixed cost per SCM basis?
It's per kg.
So there will be decrease with the price of gas or decrease with the price of gas?
Could you repeat your question?
No, there's got no linkage to the price of gas.
So they are fixed per kg?
It has got no linkage with the selling price of gas. It has got no linkage to the purchase price of gas. It is a number, a fixed number in rupees per kg, which can vary from time to time.
So that the cost, this commission to vary?
Sorry?
Yeah, it varies.
Yeah, it varies. Usually it's higher in city areas and lower in semi-urban and rural areas. So that's broadly to reflect the difference in the cost of land.
Thank you. The next question is from the line of Kirtan Mehta from BOB Caps. Please go ahead.
Thank you, sir, for giving this opportunity. You had mentioned about 2,800 conversions happening on the commercial side in Q4. Could you give us sort of the level of conversions that you have seen in Q4 across different category of vehicles and also for the annual FY22?
You want other than commercial vehicle numbers?
Yes, sir.
Yeah. So in Q4, cars and taxis put together, roughly 13,300 plus. Then three-wheelers, roughly 2,300. Buses, roughly 140. Then other than small LCV trucks, roughly 680. Total is around 19,260 vehicles.
Right.
Q4.
Right, sir. Is it possible to get the similar detail for FY22 as well, collective?
FY22, full year.
Yeah, full year.
Full year, total number of vehicles added around 62,500. Which consists of cars and taxis in the range of 45,000. Three-wheelers, roughly 6,400. Buses, 200 plus. Then trucks around 1,500. And this LCV is in the range of around 9,400 plus.
Thank you, sir. The second question would be, in terms of the volume outlook for FY23, would you be looking at sort of repeating a 4 to 6% growth, or you mentioned that you are seeing a better growth available? So what sort of the numbers is possible this year?
FY23, we are hoping for a growth better than that 5 to 6%. And what the final number is, let's see, but at least 7-8% could be possible, if not more. Again, it will depend a lot on various factors, what kind of differential price will be there between CNG and alternative fuels, because the CNG is the biggest chunk, almost 3/4 of our volumes. Industrial, as we enter into Raigad and a few other places with piped gas now, yes, that we are expecting some increase in volume there also. Domestic and commercial steadily increases. We more than 1.2 lakh customers, domestic customers, burn additional gas every year. They contribute a little bit, and that doesn't add too much to the overall kitty because per capita consumption is a bit low, but yes, it also contributes. And about 300 odd commercial customers we add on every year, they also contribute a little bit.
Thank you.
But if you look at a base year effect, because FY22, April, May, there were some issues, Jan 22, there were some issues, percentage growth could be double digit.
Thank you. The next question is from the line of Ankit Agarwal from Phillip Capital. Please go ahead.
Hello, am I audible?
Yes, you're audible.
Yes, sir, thank you for the opportunity. Just wanted to... Yeah, is it better?
Yes.
Just one clarity I needed. You said 2.5 SCMD is the APM gas volume that you got, and the priority sector total consumption was around 2.75. So that implies a shortfall of around 9%. Is that correct? Whereas you mentioned 15 to 17% shortfall.
Yeah. The percentage given of shortfall 15 to 17% is also right, because January and February there was a COVID impact. So that percentage which we are mentioning is at a peak level. So if you see March, it was higher, 17%. Some part of February it was 15%. It was lowest in the month of January because the sales volumes were impacted, and it was lower than available APM also.
Okay. So just one clarity I have needed also. Do you see any visibility? Is there any visibility on the reallocation of the APM volume that you have some visibility there? Is there a chance of increasing the APM volumes, or there is such no clarity on that?
Well, the circular and new pricing and new allocation order had come out in last Friday.
Right.
For clarity, that's the only clarity we have.
Okay. All right, sir. Thank you.
Thank you. Ladies and gentlemen, due to paucity of time, that would be our last question for today. I now hand the conference over to the management for the closing comments. Thank you, and over to you.
So thank you everybody for joining and having a productive discussion. Thank you very much.
Thank you.
Thank you.
Thank you very much. Ladies and gentlemen, on behalf of Yes Securities Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your line.